Superstars. Welcome to the Accounting Superstar channel. So glad you're here. I'm Professor Don Bush. Been teaching for about 30 years and been a CPA for about that long. And I've got great ways to explain accounting. So you're in the right place if you want to learn about depreciation today. So this lesson is designed for people who are in their very first accounting class, probably about their third week, and we're studying adjusting entries. And adjusting entries are not easy, folks. They're difficult. Everybody struggles with them. So if you have trouble with adjusting entries, you're an absolutely normal person. I've seen thousands of students, and they all struggle. And I did too. And it just takes time. But you'll do it. You'll be okay. You'll get it. Don't give up, all right? So let's get rocking here. Let's go. Here we have a company, social media partners, that bought a Mercedes-Benz. Probably a bad idea here. They spent $80,000 on this company car, a Mercedes. Now, years ago, Mercedes were terrific cars. I used to own two of them, and they were old. One was a 1975 240D, wonderful car, loved it, and I drove it 11 years without it ever breaking down. It was the most amazing car. Of course, I changed the oil and the filters, but never took it into a shop. I also had a 1990 300E, and the 300E was also a wonderful car. I drove that 9 years without taking it into the shop. The old Mercedes were well built. The ones today, they tend to have electrical problems, and they lose their value just terribly. It's awful. So, in fact, with this Mercedes here, what is expected is this. The original cost was $80,000, and the market value just drops like a rock. At the end of the first year, the market value of this Mercedes is about $60,000, and that's pretty accurate. So in 1 year, it loses $20,000 of value. In the second year, that car's worth about $30,000, and so on and so forth. Now, accountants see this loss of value differently. I know in everyday language we say, oh, the car's depreciating. And that's how you and I and everybody else talks. But accountants, they consider depreciation to be a little bit different. Here's what accountants do. Accountants simply take the original cost and they divide it by the number of years that they expect to use this asset. So they expect this car to last 8 years, and it cost $80,000. So what an accountant would do is take that original cost, divide it by the useful life. So that's $80,000 divided by 8 years. That's $10,000 per year. And what the accountant would say is the accountant would say, I'm going to expense this car at a rate of $10,000 per year. So look at that. $10,000 in the first year, $10,000 in the second year, $10,000 in the third year, and so on and so forth. So accountants are not concerned about the market value. They're concerned about expensing the car over the useful life of the car. So there we go. That's the difference. So don't think that there's any connection between market value and accounting depreciation. There isn't. There's no connection whatsoever. So here we go down to the journal entry. Well, guys, since the accountant is doing this, the accountant is concerned about the accounting depreciation. That is, expensing the car over the years of useful life. So ladies and gentlemen, here's what the accountant would do. The accountant would write down this journal entry every single year. The accountant would debit depreciation expense and credit accumulated depreciation. For $10,000, you might say, where'd the $10,000 come from? Well, it came from this very first year, the accounting depreciation. The accountant really doesn't care so much about the market value. That's not really the concern. The concern is allocating this cost over the number of years of useful life, or in other words, expensing this car over the useful life of the car. And the accountant's going to do that at a rate of $10,000 per year. Now, coming down to the financial statements, here we go. On the income statement, we'll have the depreciation expense. And I hope by now in your accounting education that you know what goes on the income statement. There's only two things that go on the income statement at this point in time, and that is revenues and expenses. All right, revenues and expenses. Nothing else goes on the income statement. Don't ever put cash on the income statement. Don't put receivables. Don't put inventory. You only put revenues and expenses ever. All right. All right, that's all you do. Now on the balance sheet is going to look like this. Here we go. I'll highlight it here. So the assets here, on the balance sheet, we have assets. That vehicle cost $80,000. That's the original cost, $80,000, and that's never going to change. That's what they paid for it. Now the accumulated depreciation, this is a brand new account, and it sounds really difficult and hard, but it's really pretty easy. The most important word in that accumulated depreciation account is accumulated, and accumulated means to grow or to expand or accumulate. All right, and so in the first year we have the accumulated depreciation of $10,000. So we just take the original cost minus the $10,000, and we have a book value of $70,000. Now, what's book value? Book value is what the asset is worth according to the books. Now, it has no reflection on reality, all right? Because if we wanted to sell this car at the end of the first year, we would probably realistically only get about $60,000 for it. And according to the books, we have it at $70,000. Well, it's not a problem. The two are not connected, so don't connect them. Don't think they're connected. Don't ever think they're connected, because they're not. All right? So let's go on to the second year. Well, for the second year, the accounting depreciation would be $10,000 again, and the accountant would do this exact same entry. The accountant would debit depreciation expense and credit accumulated depreciation. This entry does not change for this car for the whole 8 years. It's always the same. Well, that depreciation expense flows to the income statement, and it would show up here, depreciation expense, $10,000. And this accumulated depreciation, since it accumulates and it grows, that $10,000 is going to flow right down to here, but rather than $10,000, this is going to be $20,000. And so the book value is going to be the original cost, $80,000, minus the accumulated depreciation, which equals the book value. So what's book value again? Book value means according to the books, this is what the asset is worth. Now, is that reality? The answer is absolutely not. It's not reality. So what this car is really worth, it's really worth $30,000. If we tried to sell it at the end of the second year, we'd probably get $30,000 for it. And that's not an exaggeration. Mercedes-Benz is really declining in value. But according to the books, it's worth $60,000. Do you think the accountants care that much? Not really. All that the accountants are doing is just allocating the cost over the years of useful life, or in other words, expensing the car over the 8 years. So let's do the third year. Well, if we tried to sell the car at the end of the third year, we'd probably only get $20,000 for it. But the accountant, just like before, is interested in allocating this cost out. So the depreciation is going to be $10,000 for the third year. This journal entry is going to be identical. It doesn't change. You know what, folks? Do yourself a favor. Just memorize this entry. You put on the left-hand side here, depreciation expense, and indented a little bit here is accumulated depreciation. There you go. Just memorize it and you'll have it. So the $10,000 of depreciation expense flows to the income statement here. We have depreciation expense, $10,000. And this accumulated depreciation of $10,000, well, this is accumulating. It's growing. It's expanding. So this $10,000 is going to go right down here. And rather than $20,000, we're going to have $30,000. There we go. So according to the books, this car is worth $50,000. According to the books, take your original cost minus your accumulated depreciation and you get your book value. Now, according to Craigslist or whatever, the car is only worth $20,000. So that $20,000 and $50,000, there's no connection, there's no relationship, and don't ever think there is, because there isn't. All right. So guys, this depreciation would just be carried out all these years, year after year after year. And at the end of the eighth year, at the very end of this useful life of this car, the accountant would do this exact same entry. Depreciation expense would be $10,000, but this accumulated depreciation now would be a negative 80,000. There you go. So the book value is zero. But you know, the market value in 2008, they might be able to get a little bit for it. You know, the market value after 8 years would probably be about $3,000. They're not worth a whole heck of a lot. And so the book value, according to the books, according to the accountants, and the true market value, there's no relationship. There never is. So there you go. So folks, I hope you learned a little bit about depreciation. It's really pretty easy. If this video helped you out, hit that like button and subscribe. That would help the channel out quite a bit if you did that. And until next time, see you later. Over and out.